If you have questions, as always, use the chat function in the meeting, or just send me a text and I'll do my best to try to get it answered. I don't think we'll be here for the full 20 minutes today because frankly the news flow just isn't that much. But here's kind of the big topics. First, we've been reading a lot of people talking about the heat and the extended forecasts, and honestly, I just don't think this is that bullish. You've got warm weather coming through June 12th with normal precip. So you've got warm and wet coming for the next 10 days. And I think that's exactly what the corn needs, especially for some of the ground that's a little wet to begin with. Then you look a little further out and you've got in your 8 to 14 day, as we get closer to the pollination period in early July, we start to turn cool and we stay wet. So as we look at this forecast, I think the important thing to note is there's nothing in this forecast that would show lower yields. We just don't have that heat, that drought, that significant issue that's out there to make it not develop. So I just hard to buy into the bullish argument that the market's going to rally because we're getting hot. All right, enough of that. I want to show you the soybean chart here for the Brazilian for this, and then I want to look at the Brazilian real. Okay, 1,675,000,000 bushels. That's how many bushels we have to sell of soybeans between now and September 1st in order for the USDA to meet this, target. Today, we have sold less than half of that to China. So our current export pace is only 50% of what we need it to be in order to meet this number. So moving forward, we have to see over 26 million bushels a week be sold to somebody in the export market in order to hit this. And the reason that matters is because that directly impacts this number, which is our projected carryout for the new crop. If this number goes down, then the ending stocks here go up, which brings this number up right here, which ultimately raises this number. So if you have good yield, higher acreage, good yield, and lower exports, then the new crop carryout has a problem. And that is what's got the trade pretty nerved up. But what's happening here recently, so if you're paying attention to the headlines, the reason that we haven't sold beans isn't because China doesn't like us or because they're mad at us or anything like that. The reason they haven't bought is because the Brazilian real has been so low. So here's a chart of the real versus the dollar. So now when you're looking at this, this means that the real is cheap. So if the dollar is strong against the real, then the real is inexpensive. And so as the trade war phase 1 got underway, China started buying more and more beans from Brazil, and everyone freaked out. And in the last 60 days, they've in fact bought record amounts. They've bought more beans from Brazil than they've ever bought at any time in history. And this makes sense. It wasn't because they're mad at us. It's because these were screaming cheap because just because of the currency fluctuation. But here over the last few days, the real has collapsed or has rallied as the dollar has collapsed against it. So we're now starting to see U.S. beans become way more competitive. And if this continues its downward trend, then that puts our beans front and center for China coming into their main our harvest window, right? August, September, October. So this should help the USDA get to that number on their export. That's the point behind all of that. So when we look at the soybean chart, you're starting to see a little bit of strength in it, and that's why. It's because we're starting to move some product. So here's the soybean chart that we put up. Remember, this green square has absolutely no meaning because we drew it ourselves, right? I hand drew this last week during the presentation, but I did it because it covers the upper band of resistance and the lower band of support that we've been looking at. And Monday, Tuesday, Wednesday, right? Monday, for all intents and purposes, looked like we were going to take out new lows based on the news that China was going to stop buying from us and had ordered their firms to quit buying. Then later in the day, it was reported that they had actually bought on the same day. So you have totally conflicting news stories. And then yesterday, the traders seemingly took hold of the positive news story and took hold of the fact that the real was starting to devalue or cheapen up against the dollar. So those things started to push us up into our upper end of our range, and we're now inside our cloud. So beans could get really hot. These are poised to challenge this 861 level, and if they break it and can work themselves up on a closing basis and hold it, that really could accelerate a move higher in soybeans. So stay tuned and be watching for flash announcements, because if the real is collapsing and we start seeing flash sales announcements moving forward, then that is a sign that China is buying, and it could be and it really could become a bullish catalyst for that market moving forward. Now on the downside, we do have the threat of higher acreage. If guys started to plant more beans over corn because they were scared of corn, then that acreage number could come up, and the weather, we could hit above trendline yield. And if those two things happen, beans, that will be like a lid on beans. So we want to give it some room and let it rally just a little bit if it's going to. But if we get back up into this $9 mark, we probably want to put some sort of protection on, because now you've got weather risk and you've got demand risk if we rally too far too fast. So I wouldn't fall for any headline bait. I would just let the chart tell you what it's going to do. And right now it looks like we could get the summer rally that we've been looking for. So the question is what is corn doing? Let me start with old crop corn. This is July corn, and then we'll move to December. This chart really doesn't look too bad. As this support holds, the question, and one of the authors on AgWeb put it this way, said, is corn building a base, or is it walking towards a cliff? And I think that was a really eloquent way to look at this market, because it truly could be doing either one, right? But the best reading as of today is that we're looking for this to challenge 330, and if it can break it, then that should ignite us a little bit higher on July corn. If we look at December, it actually looks a little bit better. So I'm going to flip back. Notice this little pattern here, right? You've got a couple of days down, and then you start to reverse just a little bit, where our low today is higher than our low yesterday. Wrong chart. By contrast, July is a little bit different, where today's low has already taken out yesterday's low. So one of those two is going to be accurate, and December seems to be finding more support than July does. So you could see carries widen, which could be also negative for basis. So if we can break this 342 level, that could trigger up into this rally. And this is exactly why we've been talking about setting basis for the past couple of weeks. Basis is usually your best when prices are low. and basis tends to widen as the futures price rally. So what we didn't want to have happen, and we've been taking basis deals even though they're not the greatest deals in the world and they're not setting anything on fire, but we've been taking them because we didn't want to see a 30, 40, 50 cent futures rally. We didn't want to see half of that or more get eaten up in basis slide. So our only defense against that is to set it. So that's why we've been encouraging that. And then again, we like the accumulators because they let you price into the market here today. And if for some reason things turn more bullish than we think they are, and we crawl above this 382 level, that's the point at which we're going to start to look to re-own things that we've sold, because a move back above this line, which is triggered off of this major break here, right? A move back above that would tell us that something has changed, and we're no longer range bound. We're now looking for a more sustained directional move. But anything below this is a counter trend move and should be sold, in our opinion. So I'm going to leave this intact. I think we're poised exactly right to get a rally into here, but we don't have to. And so it's prudent to manage some risk, remove some downside, and you can always make adjustments as we move forward. All right, let's look at wheat. We said last week we were bullish above 440. It rallied right to the bottom of its cloud, and then turned right around. It looks like the production just isn't going to be hurt the way we'd hoped it was going to be hurt. And then the ratings report came out this week, and the good to excellent ratings on our spring wheat crop is really good. The trade thought that we were going to be at 66%, and we came in at over 80. So that offset the negative reading that we had on Kansas City wheat. So I think now the wheat market turns its attention to corn and to the dollar. If corn rallies and the dollar gets cheaper, then I think wheat's going to keep finding support down in this area. If the dollar rallies and corn doesn't move, then I think wheat could be in significant trouble. So a move below 440 will confirm that a true new downtrend is in place, and a move back above 470 would turn the chart significantly more bullish and give us a little bit of an upward bias. But it's not until we take out these prior highs that you could say that a true bull move is getting ready to unfold in the wheat market. So wheat is sideways, it's range bound. Even though it's a very wide 90-cent range, it's still what it's doing. It's very hard to discern a direction from the top to the bottom. I think right now you just have to look at this low, and if it holds, it's support. If it doesn't, then we're starting a new downtrend, and we don't know what the low would be in that instance. So I'm going to jump back to corn here for 1 second because I want to show you one more thing on July corn. All right, so I'm going to narrow the time frame in for you just a little bit. We've been looking at daily charts. This is a 240-minute chart or a 4-hour chart. And what's interesting is that just this week, we've started tracing this wedge pattern. And for those of you that have listened to me for a while, we really like wedge patterns because the breakouts tend to be decisive. Last night, we closed right on the upper end of its wedge, failed to break it. So we tried to sell it down, and now it looks like we're finding a little bit of support here going into the break. The upper end of this wedge is 323. The lower end is 320.5. And if you look at that 320.5 level, that's also this level right here at right here on this major hedge line, which would put us short below this line. So if we break that short-term wedge line and break through this 320, that should accelerate a move to the downside and set up a challenge of 313, possibly even 309 on the July. On the flip side, if we break out the top and we can close back above this 330 level, it ignites it. So very critical juncture for corn. If you read the news, the funds are short 300,000 contracts sitting here at this level. I don't know how much more ammunition they can have in order to push this market that much lower. So our bias is higher on corn for a lot of reasons, and that's chief among them. Is that sometimes if they want to break a market and get it down into that below 3, sometimes before you break it, you have to rally it to reload your weapon, and then you can sell it. So we're looking for a rally, even though we're really not all that bullish. And I guess that's the best way to put it for today. It's been 16 minutes, and I'm not gonna spend any more time. If anybody's got questions, let me know. I'm happy to talk to you, and we will talk to you next week.